Money is used every day by billions of people. We earn it, we spend it, we save it, we measure our success with it, and yet most people never stop to define it properly. Ask 10 economists what money is, and you will get 10 different answers. A store of value, a medium of exchange, a unit of account. All correct and all incomplete. Because money is not just a thing, it is a system, a social agreement, and a technology for coordinating human behavior at scale. To understand modern economies, investing, inflation, and debt, you first need to understand what money really is. A common misunderstanding is that money equals value. But money is not value. Money is a way to represent and transfer value. You cannot eat money, you cannot live inside it, you cannot use it directly to build infrastructure. Money is not wealth itself. It is a claim on wealth, or more precisely, a claim on future goods and services produced by society. This distinction matters because it explains why money can lose purchasing power even when nothing physical changes in the world. At its core, money exists because people agree it exists. A piece of paper has no intrinsic value. A digital number in a bank account has no physical form, and yet both function as money. Why? Because society collectively agrees to accept them in exchange for goods and services. If that agreement disappears, money stops working instantly. History shows this repeatedly. Currencies collapse not because paper disappears, but because trust disappears. Economists usually define money through three functions. First, a medium of exchange. Money removes the need for barter. It allows trade without direct coincidence of wants. Second, a unit of account. Money provides a common measurement of value. Prices, wages, debts, all expressed in the same unit. Third, a store of value. Money allows people to transfer purchasing power across time. But none of these functions explain what money is made of. They only describe what money does. Modern money is fundamentally a ledger system. It is not physical. It is accounting. Every bank account is a record in a global database of claims and obligations. When you pay someone, numbers are updated in that ledger. No physical object moves, only entries change. Even cash represents a claim on that system, because cash itself is issued by institutions that maintain the ledger. This means money is not stored in banks. Money is recorded by banks. Money did not begin as abstraction. It evolved step by step. First, commodity money like gold and silver. Then, representative money like paper receipts backed by gold. Then, bank money created through credit systems. Finally, fiat money, fully digital and not tied to physical assets. At each stage, money became less physical and more abstract, but also more powerful, because abstraction allows scale, and scale allows global economies. Modern money ultimately depends on trust. Trust in institutions, trust in laws, trust in central banks, trust in economic stability. Without trust, money loses function immediately. This is why inflation is not just an economic phenomenon, it is a trust phenomenon. When people lose confidence in money's future purchasing power, they change behavior. They spend faster. They move into other assets. They seek alternatives. This accelerates currency decline. In modern systems, most money is created through lending. When banks issue loans, they create deposits. Those deposits become money in circulation. This means money is closely tied to debt. More lending equals more money. Less lending equals less money. This is why credit cycles matter so much, because they are also money cycles. Money is not fixed. It expands and contracts with financial activity. Money is also a tool for coordinating time. It allows future production to be used today. When you borrow, you are spending future income. When you save, you are deferring consumption into the future. This creates a bridge between present and future economic activity. In this sense, money is not just a medium of exchange. It is a mechanism for distributing time. If money is a claim on future goods, then its value depends on how many goods exist relative to claims on them. If money supply grows faster than production, each unit of money claims less real output. This is inflation. But inflation is not only about prices rising, it is about purchasing power shifting. More money does not automatically mean more wealth. It often just means more claims on the same resources.
Money is also a policy tool. By controlling interest rates and liquidity, central banks influence borrowing, spending, investment, employment, inflation. This makes money one of the most powerful coordination systems in modern society. It shapes economic behavior without direct commands. Instead of forcing action, it changes incentives.
Modern money has a paradox. It enables unprecedented economic growth, but it also creates structural dependence on expansion. Because debt-based money systems require continuous economic output to remain stable. If growth slows too much, debt burdens become harder to sustain. If growth accelerates too quickly, inflation emerges. The system must constantly balance between expansion and stability. So what is money, really? It is not gold. It is not paper. It is not numbers in a bank account. Money is a social technology, a shared system that allows people to coordinate economic activity across space and time. It is a belief system backed by institutions, laws, and collective behavior. And it is a living system, constantly created, destroyed, and reshaped by credit, policy, and trust. Money is powerful not because it has intrinsic value, but because it organizes how value moves through society. It connects effort to reward, present to future, individuals to global systems. And the most important thing about money is not what it is made of, but what it allows humans to do together. Because in the end, money is not the goal. It is the coordination system behind almost everything we call the modern world. If you enjoyed this episode, subscribe for future deep dives into investing, macroeconomics, financial history, and global markets. Subscribe and stay with us. See you in the next videos.